The repo market. Is the crisis getting worse? Let me answer that question for you right now. Yes, absolutely it is, and here's why. Here's a timeline of the Fed's repo operations per their website. You can check it out at the New York Fed's website for yourself. But initially they came out and made these announcements September 20th. This isn't when they started the repo operations, just when they announced it on their website. And they said that they're going to do these term repos, which means the repos have a specific date on them, of 30 billion plus, and that's going to end October 11th. The overnight repos, that's just that overnight transaction, is going to be 75 billion plus. That would extend to October 10th. Well, sure enough, on October 4th, they came out and they upped the term loans from 30 to 35 to 45 billion, and they're doing it till the end of October. So you see what's happening? The amount of money is increasing, and the length of time that they're committing to is also increasing. Going to the overnight repos, that's still at 75 billion plus, but now they've extended that from October 10th to November 4th. They then came out on October 11th and said, okay, we're keeping it at 35 to 45 billion plus for the term repos, but we're extending it to January. So from the end of October till January, and they're keeping it at 75 billion plus for the overnight transactions, and they're extending that to January as well. One thing that shocked me when I was actually reading this, because I haven't really heard this anywhere in the media, but if I was reading this right, they said that they were starting to buy 60 billion worth of treasuries starting in October 11th. This is huge. The reason why, technically, they're doing repo operations, which means they're buying that collateral from the individual bank or from the borrower, but that borrower is committing to buying that back from them at a specified time. Where here, the Fed's just admitting that they're buying these long term, and it's going to add and increase their balance sheet. Then October 23rd, they came out, said that the term repos were going from 35 to 40 straight to 45 billion plus. And they made an amendment to the overnight repos going from 75 billion to 120 billion a night. And I want to remind everyone that the Federal Reserve, as of right now, has $1.3 trillion in excess reserves, meaning that the banks are parking 1.3 trillion at the Fed above and beyond their reserve requirements. Why is that a big deal? Let's remember how the repo market works. We've got these financial institutions, and overnight they need cash. All they have is collateral, usually in the form of treasuries or mortgage-backed securities. So they'll go into the repo market and they'll pledge their collateral for that cash that they need overnight or for that specific term. And the rate of interest that the lender that's giving them that cash overnight or for that term can get in the repo market is much higher than they can get by parking their money at the Federal Reserve. So that begs the question, why? Why on earth would you park 1.3 trillion here when the market only needs 45 or 120 billion, when you could just take this out, bring it over here, and get a much higher return on your money with collateral that's supposed to be quote-unquote risk-free? I also want to address another liquidity issue that everyone talks about. And yes, the Fed is injecting liquidity into the repo market because there's not enough cash. But let's remember that all these people that are holding the collateral that might not need cash, all the banks and financial institutions, they can easily sell the treasuries that they have, like the primary dealers. Then they could take that cash and put it into the repo market and get a higher return, just like they could by taking their excess reserves and putting them into the repo market. So this puts a huge question mark over the repo market. And you have to say, well, is it the collateral that they're worried about, or is it the solvency of the institutions that are trying to borrow the money? I want to give a big thank you to the guys at wolfstreet.com. They came out with a fantastic video on the repo market. We'll put a link in the description below. And they pointed out the fact that a lot of these people that are borrowing in the repo market are these banks and mortgage institutions that make money by borrowing short at lower rates and lending long at higher rates. All right, guys, let me take a quick time out here and explain to you exactly how this business model works of borrowing short and lending long. It can be a little confusing for those of you who are not in the financial industry. So as an example, we'll use, of course, the repo market right here. And I want to point out that the majority of the businesses that use this as a model actually get their short-term lending from the repo market. So this is very applicable to this video. So we've got a mortgage company right here. We'll use that as an example. And let's say that they borrowed $1 million. And they come into the repo market and they borrow that $1 million for 1 month, and they pay 2% interest. Whenever we refer to interest rates, whether it's the interest rate that the Fed pays on a treasury or the repo market, we're referring to annual rates of interest. So they're paying 2% annual interest for this 1 month loan of $1 million. The mortgage company takes that $1 million and they lend it out to all of these customers who are looking for mortgages to buy homes. But they lend this money out for 10 years at a 4% annual interest rate. So the mortgage company is pocketing the difference between the 2% and the 4%. Now you may be asking yourself, well, George, wait a minute. That doesn't make any sense at all. Because how on earth are they going to pay back this $1 million that they borrowed, because they only borrowed it for 1 month? This is how they do it. They come right back into the repo market and they borrow an additional $1 million to pay off the original loan. We call that rolling the debt over. So they're constantly borrowing and paying back this original $1 million loan because they've got the $1 million that's out there in the real economy in the form of mortgages for these customers' homes. So they've got a $1 million loan that they're paying $20,000 a year to borrow that money. They're lending it out at $40,000, so they're pocketing the difference of $20,000. Let's just say they've got some admin costs for $15,000. So this business will generate $5,000 a year for this $1 million that was originally borrowed. The problem is if these short-term rates go higher than the rate of interest that they're getting for their customers, they're at a loss and they go out of business. That's why the Fed is so concerned about the repo market in addition to that short-term Fed funds rate. So the Fed's got to keep a careful eye on this because there could be a lot of systemic issues. A lot of these companies could be, quote unquote, too big to fail, just like in 2008. So is the repo market crisis getting worse? Yes, absolutely it is. But we still don't know exactly what's wrong. That's why we've got to pay very close attention to this moving forward. And I can say this, I don't know exactly what's going on with the repo market, but I do know that it's something really, really big. For more information on the repo market, check out this content right here, and I will see you on the next video.